Ladies and gentlemen, good day and welcome to the Max Healthcare's earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suraj Digwalekar from CDR India. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us on Max Healthcare Q2 and H1 FY23 earnings conference call. We have with us today Mr. Abhay Soy, Chairman and Managing Director, and Mr. Yogesh Sareen, Senior Director and Chief Financial Officer. We will begin the call with opening remarks from the management, following which we will have the forum open for interactive question and answer session. Before we begin, I would like to point out that some statements made in today's discussion may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks. Thank you, and over to you, Abhay.
Very good morning to everyone. We are pleased to welcome you to Max Healthcare's Q2 earnings call. Let me start by giving you updates about the company performance for the quarter. Like the previous quarter, this was a normalized quarter. We witnessed a steady growth in occupancies driven by improved patient footfalls from international and insurance segments. There were concerted efforts to unlock value through previously articulated growth levers. Consequently, we delivered our best ever performance for the second consecutive quarter this financial year. A significant development this quarter is that we are now a net cash surplus company. Compared to a net debt of 217 crores at the end of Q1 FY23, we have a net cash surplus of 42 crores at the end of this quarter. We are also happy to share that our digital app, Max My Health, has been successfully launched at the end of September 2022. The app has enhanced the experience of both patients and clinicians in our ecosystem. It provides a gamut of services including pathology, radiology, ambulance, home care, and facilitates physical and virtual consults, among other things. It also provides access to patients' health records and trends at the click of a button. Before I move on to the highlights of this quarter, please note that in Q2 last year, we had a revenue of 91 crores and an EBITDA of 25 crores from COVID-19 vaccinations. Since this was a non-recurring revenue, the comparative numbers and percentage are thus being reported on a like-to-like basis. Key highlights of our performance in Q2 are occupancy for the quarter improved to 78% from 74% in Q1 FY23 and 75% in Q2 FY22. Institutional bed share has been brought down to 28% this quarter from 30% in Q1 FY23 and 37% in Q2 FY22, in line with our strategy. Consequently, the institutional revenue share dropped to 16% compared to 23% last year. Revenue from international patients grew by 16% quarter on quarter and reflected 110% of pre-COVID average despite negligible patient footfalls from Afghanistan, a key territory for us that contributed around 12% of the revenues previously. Network gross revenue rose to 1,567 crores, our highest ever, reflecting a growth of 6% quarter on quarter and 17% year on year. ARPOB for the quarter was 66,000, same as previous quarter, but grew 12% year on year. The mix of medical patients went up compared to last quarter due to seasonal infections, and this was reflected in the lower ARPOB. Increase in ARPOB over Q2 last year was led by improvement in the payer mix and case mix, as well as annual price revisions. Network operating EBITDA for Q2 FY23 was 410 crores compared to 370 crores in the previous quarter and 337 crores in Q2 FY22. reflecting a growth of 11% quarter-on-quarter and 22% year-on-year. Indirect overheads were up during the quarter due to relatively higher provisioning for CGHS bills outstanding beyond 365 days, in line with our tight provisioning policy. Seasonal cost increase for power and marketing expenses related to international patients. EBITDA margins improved to 27.7% versus 26.6% in Q1 FY23 and 26.7% in Q2 FY22. Annualized EBITDA per bed, most importantly, rose to 64.3 lakhs, our highest ever, clocking a growth of 4% quarter-on-quarter and 17% year-on-year. Q2 FY23 PAT was rupees 267 crores versus 229 crores in Q1 FY23 and 207 crores in Q2 FY22. This excludes gain of 244 crores in tax expenses due to reversal or deferred tax liability relating to intangible assets transferred to MHIL pursuant to voluntary liquidation of Saket City Hospital Limited. During Q2, 28 crores was deployed towards ongoing capacity expansion projects. Construction of 100 beds at Shalimar Bagh and 300 beds at Dwarka is on track, and we expect them to be commissioned in last quarter of FY23 and first half of FY24 respectively, as indicated earlier. The outlay for some of the expansion projects has been deferred in view of ongoing discussions with some of the world's top contractors for faster build-out. Digital revenue grew to 242 crores and accounted for 15% of overall revenue. Continuing our effort to give back to the community, we treated 39,700 OPD and 1,300 IPD patients from economically weaker sections of society free of charge. Both our strategic business units continued their growth momentum. Max Lab reported a gross revenue of 30 crores. This reflects a growth of 21% quarter-on-quarter and 65% year-on-year on like-to-like basis. We added 65 plus channel partners during this quarter, taking the overall active clients to 900 plus, and now offer our services across 34 cities. You may keep in mind that we have made huge investments towards Max Lab for the organic growth in the past quarters. Max at Home reported a top line of 35 crores, reflecting a growth of 9% quarter-on-quarter and 26% year-on-year, supported by a team of 800 plus people. Max at Home offers services across 13 service lines and enjoys a high degree of customer loyalty. Now coming to the overall overview of the company's financial performance in the first half of this financial year. Network gross revenue stood at 3,040 crores, reflecting a growth of 17% year-on-year. Network operating EBITDA grew by 22% year-on-year to 780 crores. Increased OPD footfalls, improved case mix, and reduction in institutional bed share resulted in margin expansion by 120 basis points to 27.2%, while EBITDA per bed grew by 26% to 63.2 lakh rupees per bed. We continue to focus our efforts on the growth levers articulated earlier. That is, we are making significant investments to expand our bed capacity in the next 3 to 4 years, which is in line. Second, to complement Indian government's initiatives such as Heal in India, we continue to augment our international outreach initiatives and setting up offices across new geographies. We are also actively looking at inorganic expansion opportunities across existing and new markets, and we continue to improve our case mix through deployment of technology and hiring new talent. With this, we open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Krishnan Amarchand Toshniwal from Polar Ventures LLP. Please go ahead.
Yes, ma'am. Good morning.
Hi, good morning.
Hello. Am I loud and clear?
Yes, we can hear you.
Yeah. Just wanted two questions to be answered. How do you see the international business growth in the coming quarters?
We're very positive about it. It's been growing, like I mentioned in the announcement, that is already 110% of pre-COVID levels. This is in spite of the fact that 12% of our business, our key market was Afghanistan, where the Indian government right now is not issuing visas. So once that opens up, you will see, and we hope it to open up shortly, because things seem to be normalizing over there, at least from government to government perspective. And once that happens, this will augur even better for us. It's a big thing to say that we've been able to sort of compensate and overcompensate this through other growth levers that we've invested in the international business. So that's done well. And we are quite positive about it going forward. I think, if you couple this with the new Heal in India program of the Indian government, it's very similar to Make in India, which, has been sort of announced by the government. I think that will give us huge impetus, particularly because we have so much of a capacity in the metros.
Mm-hmm. Okay. The second part is that how is that Nanavati doing after the VRS and all, after the VRS has been done?
It's been doing reasonably well. We are in mid-teens as far as the EBITDA margins are concerned. Going forward, hopefully we can go back to the rest of the portfolio as well. But like I mentioned in the past, the ROC, it's the highest amongst the ROC, although in terms of percentage, the EBITDA margins are lower than the rest of the pack.
The building that was coming up, which has been already dismantled and you started work, how is the progress on that?
Very well. I think we are well on schedule as far as that is concerned. The piling work has been completed. We are beginning excavation soon. And you're going to see that online in the next 2 years.
Thank you very much. Best of luck for the career.
Thank you.
Thank you. The next question is from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Yeah, hi. Good morning, everyone.
Hi.
My first question is on the capex plans of the company. If I look at first half, the capex incurred is, I think, 41 crores, if I'm getting that number right.
That's right.
And I think the budget in the most recent investor presentation was around 657 crores for FY23. So, any particular reason why this gap?
I think, so a large amount of it was to be bunched up towards the second half. It's a little difficult to sort of break it up. You're going to see a majority of that investment happening in the first half of the current year. Of course, one is engaging contracts, engaging vendors and work starting, etc. But besides the mobilization advance, really the payments start happening on delivery of certain milestones. I think as and when that happens, you will see that payout happen. It's a little, when you're making 5-year plans for so many hospitals, it's a little difficult to sort of put it out quarter by quarter, so we put it out in a year. So you're going to see significant investments will be invest the entire 640 crores in the second half of the year, doubtful. But will it sort of bunch up with the first quarter of the next year? Likely. But at this stage, we are not seeing any delays on the overall project schemes.
Right.
I'll give you an example, because when we were conceiving the projects, you look at, construction as usual, but then new technologies such as structural steel and hollow tubes, etc., which cuts down timelines as far as the entire construction is concerned. But, it sort of takes you back a little bit into the planning stage about how to technically go about it. So that's why, we don't see delays because we see benefits coming out of using, alternate medicine. They may be marginally more expensive, but, that's the new sort of way of doing things faster these days.
Okay. So it can be safe to assume that capex running behind budget will not have any impact, at least on Shalimar Bagh and Dwarka. Is that the right assumption?
So absolutely not as far as Dwarka is concerned. We are hoping within the first quarter of next year for it to come on stream. And as far as Shalimar Bagh is concerned, it will be on stream early on in the last quarter than the current year. So Shalimar Bagh expenditure has been as per budget, as per plan. So there's no sort of delay over there. And Dwarka, as you're aware, there's actually somebody else who's constructing it, and that's well on stream.
Got it. And second question I had on Max Lab. Now, there seems to be some pretty strong traction building up from Max's perspective. There's quarter-on-quarter growth, there's YOY substantial growth in non-COVID revenues, and I think you have added quite a few partners as well. In 2 quarters, I think 150 partners have been added. So 2 questions here. I mean, A, obviously it would be very helpful if you can share the Max Lab outlook from a 3 to 5 year horizon. And B, when you talk about partners, is it some sort of a franchisee model or who exactly are these partners? Some revenue sharing happens, if you can help us understand a bit of construct here and how you're going about growing your business.
Yeah, so I think, the 2 things. One is we've been investing heavily in this business. When I say investing, both in terms of there's been mild investment towards marketing, but investment towards creating partners and partnerships with franchisees and so on and so forth. I think in the first quarter of the current year, we added about 400 odd franchisees to this, some significant sort of this thing. So your EBITDA sort of gets depressed because of the investments that you're making in it. So I don't want you to kind of get misguided by looking at lower EBITDA margins, or somebody actually mentioned to me that from a loss-making this thing in the past quarter that you've gone into a marginally profitable, etc. But this is on account of the new sort of investments that you're making. I think overall this business has always been profitable. There's no reason for it to not to be, etc. And if you were to sort of draw a line and not grow, immediately you'll see this business coming into profitability, but that's not what the idea is. It's about such an underpenetrated market, and we have such a strong sort of brand and strategic advantage and comparative advantage compared to other players in this, that we continue to invest in the business. Yogesh, do you want to sort of shed light on what sort of arrangements that we have?
Yeah, so we have obviously we have franchise models. We have our own company-owned centers. We then also have a model which is the Flabo at site. This is we make station a Flabo at the nursing home of a doctor, etc., or a smaller hospital. We also have HLMs, right? We do third-party hospital lab management in this. There are more than 20 labs that we manage here, big ones I would say. And then we also have pick-up points where our Flabos go and pick up the samples from. So there are obviously various models. I would say the HLM is the deep discount model where we get probably 55% of the amount billed to the patient, but others would be a discount of 25 to 30%. Right, so that's the typical model. In obviously company-owned center we bill at retail price, so there's no discounting there.
Right, and in terms of the lab network, are only the hospital-based labs being leveraged as of today, or there are some standalone labs as well, and what's the lab network outlook over the next 3 to 5 years?
So as of now, we are leveraging the hospital lab, and not only our own hospital, but also these HLMs that we have, right? This third-party hospital lab management that we do. These are hospitals, so we pick up samples and try and get it tested in the nearest lab. The nearest lab may well be a lab which is managed by us, but not owned by us. So I think that's the way it is. So they have their own labs in terms of the HLMs, but I think they don't have a reference lab of their own. The Max Lab team, I think they will certainly be looking forward to one once the business scales up.
Got it.
I mean, right now we have spare capacity in our labs, so we obviously use that. But as and when there's a need for a centralized lab, I don't think there's a problem. And in case the investment isn't too much, right? It's a very negligible sort of investment towards.
Yeah.
Right. So, I mean, would you comment, Abhay sir, that Max Lab, now that it is crossing 100 crore kind of a revenue mark, if I analyze this quarter numbers, is as important a piece for the company as hospitals? Can it be looked at that way?
No, absolutely. It always has been. I think, we started focusing more on it. And even in the past, we also said we'd like to look at inorganic growth, but obviously, sort of numbers and valuations and, the dynamics of the industry sort of changed. So we decided to kind of look at focus on more on the organic growth as far as this is concerned. But this is always going to be a key focus area, and otherwise we won't be in it. Otherwise, we won't be showing it as a separate segment. And similarly, I mean, you're saying this about Max Lab, and similarly about Max at Home as well. And you've seen, I mean, that's a high number, and it's a profitable business. It does mid-teen sort of EBITDA margins. It's the largest home care business in the country, and actually the only profitable one. And we're very, very excited about that as well. I mean, the traction that we're getting is essentially giving you a hospital it's extending a hospital to your home.
Sure. Thank you so much, sir. That's all from my end.
Thank you.
Thank you. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, hi, good morning, and thanks for the opportunity. So first question, trying to understand this occupancy run rate better. So we've been tracking very well and now touching 78%. I understand Saket and other marquee ones would be even higher, 85% plus. So what is the headroom here for us to, max out on the existing hospitals?
So look, I think there are 2 or 3 things that you need to look at this in perspective. Okay. We are pre-COVID level, we were at 70 to 73%. Compare it to about 75%, 76% post-COVID. As a base. Now, certain quarters, and particularly Q2 every year, is that's the time when you have the rains, etc. So you have more viral diseases, more dengue, and so on and so forth. This quarter is typically characterized by higher occupancy, okay, because of more medical patients coming. But also, it's characterized by, because these patients, your earnings from these beds are lower, okay, you have a downward pressure on ARPOB. Yes. So although you see the 78% occupancy, okay, it's basically this peak is a little bit happened because of the the viral load and the medical business which has come, the dengue business and so on and so forth, which is a seasonal business. Having said that, you also have a secular increase, okay, in your business as usual, which is your surgical business and your regular business, which is the non-seasonal business, which is further augmented by, your international business reverting to even higher levels and growing, your insurance business growing and so on and so forth. So what you're going to see in the subsequent quarter is and this business, okay, it will bring you little higher occupancy, but it also brings you higher ARPOB. Overall, when you look at a 70, or let's say a 75 to a 78% sort of a range, okay, of occupancy, your question being, where do you sort of go from here? You have to keep in mind that even now, 28% of the total beds, that means of the 78% occupancy, 28% of the 78, so almost like 1/3 of it, okay, is being consumed by institutional business, which is very low ARPOB business, and the ARPOB basically is close to half of what the ARPOB for the business as usual is.
No, I understand that. That was my second question anyways, but occupancy-wise, what is the max we can get over?
So let me put it this way. In the month of September, we were operating at 81% occupancy, right? I mean, if you ask me the same question, we have hospitals which are operating at 90% plus occupancy. The question is, can all hospitals operate at 90%? Theoretically, yes. Okay. 1 year back, somebody asked me that, look, on a sustainable basis, can you operate at 77, 78%? I was been difficult. Today, I'll say yes. Next year, I'll say, look, you'll probably ilk out 2 more percentage points over here and so on and so forth. But you're pretty much, look, in my mind, 77, 78% occupancy on a sustainable basis is where you should be. And then, your patient services, etc., on the subjective area start getting compromised a little bit.
Understood. Fair enough. Thanks for the elaborate answer. So second one is similar on the ARPOB side, as you already touched that you already declined to 28% in terms of institutional business versus 37% a year back. So here, do we have minimum threshold where we have to give minimum institutional services to central government employees, or this can go to, say, 10%, 0%? What is the view here over the next 4 to 8 quarters?
So I can give a 30-day notice today, and at the end of 30 days, bring this business down to zero. Keep in mind one
don't have any obligation. Okay.
None whatsoever. Okay.
So what is our goal for the next 4 to 8 quarters?
So I do this business because I want to do this business, not because I have to do this business. We do this business because we don't want the bed idle. If I bring this down to zero today, my occupancy comes down to 55, 57%, right? The next question is, why aren't you filling those beds? Now, my goal in the past also, we said, that 5 quarters later or 6 quarters later, this will be below 15%. And that goes down to 15% because that's when majority of my capacity starts kicking in as well. Now, I would say not 5 to 6, I'll say 4 to 5 quarters. And we always sort of guided down to that we'll comfortably come down to 15% or below. And the reason is that the new capacity comes in. Suppose the new capacity wasn't to come in or was to get delayed, this goes down even further.
Perfect.
So that's the advantage within this thing. These beds are built, they're suboptimally used right now. Okay, and you have this entire brownfield, etc. kicking in.
Okay, perfect, great. And one more question was on, the CCI probe which came in on, a few of the hospital companies, including yours.
That's right.
So if you could give some color, is it to do with the annual price hike, or is it due to that we came into limelight because our ARPOB is highest in the industry today? How are you tackling this? Because I heard in your opening comments that you've still taken price hike.
So I'm glad you asked this question. Okay. This is purely and simply relating to a case in 2015 where a person came to the hospital and said that, look, a syringe, you're delivering a medicine at, an injection at so-and-so price, okay, whereas I can get it from a pharmacy at so-and-so price, which is lower than that. So I should be able to bring my syringe in. And he went and complained regarding this. The sum total of this case is that they're saying that, look, okay, I think firstly it's an investigation that they've done. Okay, they've asked us for a response on that investigation. Okay, they haven't given us the basis of that investigation. So we went to Delhi High Court and we said, please ask them to give us a basis for the investigation so we can give a response. Because as a hospital, what we do is we do not sell medicines and injections. We apply it. Right? What we sell is at MRP. So, I mean, for the life of me, we can't understand where we are sort of off track on this, because we sell at MRP and we are not in the business of selling the medicines, and we sort of, the nurse comes, gives the injection and so on and so forth. It's got nothing to do with any price hike. It's got nothing to do with pricing. It's got to do with, is a patient allowed to bring his medicine from outside to in? I mean, that's not even the jurisdiction of the CCI. Frankly, because we can't have somebody bringing a spurious injection, okay, which may not be sterile or whatever, from outside the hospital to inside the hospital.
Perfect. No, this is very helpful. Thank you.
As narrow as that. And there's some comments made on the investigation, okay, which we don't know the basis of, okay, such as the hospital beds are, the rates for the hospital beds are more than 4-star hotels in the neighboring this thing. Now, 4-star hotels, as you are, firstly, nothing stops us from selling our beds at any price. That's one. Secondly, and it's definitely not the jurisdiction of the CCI. Secondly, we don't sell rooms. There's a nurse, there's a doctor, and there are all of those services which comes with the beds, etc. So you can't make a like-to-like comparison, right? I mean, right now it's at investigation. Then if we will give a response, if it's a litigation, it will be a litigation, or it will be killed by them at this stage.
Okay, got it.
Raj, also the question is that when we have 70% of the patients being treated on a cashless basis, how can we ask patients to bring medicine from outside, right? So they are saying that you allow patients to bring medicine from outside. Now, I mean, the whole cashless, falls if that also happen, right?
Okay, got it. Okay, and my last question is on your M&A and asset-light strategy, given that, you have a 6-year, 7-year plan. You're doubling from internal accruals largely, but still net cash balance sheet. But to propel growth or maybe add on to the growth, we've seen some companies like KIMS buying out doctor-owned models, hospitals which are not run properly. What is your thought there, or what are the M&A and asset-light acquisition plans you have?
So look, we've written the playbook on it, right? I think essentially, as far as buying hospitals, unlocking value, but you have to maintain a certain critical mass and be able to do it, etc. Because KIMS or anybody else finds an opportunity, does it, is not the sort of this thing. We at any given point of time are diligencing companies. We are very, very focused on inorganic growth, and like you rightly pointed out, we have an unlevered balance sheet and we have excess cash on the books. We can easily sort of do that, but at the same time you have to maintain. We have a ROCE of 33%, and whatever we do needs to be accretive to that in the long run. And I'm fairly certain in the next, sooner than later, we will be able to conclude another transaction. But do keep in mind, over the last 10, 12 years, our entire platform has been based on acquiring assets, unlocking value. It doesn't sort of stop us from doing it. We have a stronger balance sheet, stronger team, stronger abilities to do that, to execute even better on this.
So you would be still looking at it, but you're not talking about it, which way you're going. I mean, is it asset light? Is it KIMS model? Is it straight away M&A?
No, so look, partnering with doctors, etc., doesn't excite us. If we like something, we want to own more of it than less of it, and we like to have control on it as well. And I think, sort of our EBITDA per bed, keep in mind, is 50% better than the next best player in the industry. So obviously, our model is works very well for us and for investors.
Okay, no, that's fair. Okay, thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi, good morning. Thank you for the opportunity. My question is on new bed addition happening over next 9 to 12 months. So we have Shalimar Bagh and Dwarka adding around 400 new beds. So currently you are operating at somewhere 26-28% EBITDA margin. So after these new beds come in, should we expect some dilution in margins, or other way to ask you, like how fast you think these can achieve EBITDA break even after the launch?
I think the way to look at it is look at what our EBITDA per bed is, okay, and then you say, look, if this is a 400 beds coming, how long will it take me to get to, let's say, 75% occupancy? That's about, I guess, 300 beds, and multiply it by the EBITDA per bed. So yes, I think as far as Shalimar Bagh is concerned, it should be a matter of there's no dilution. In fact, day one there should be accretion as far as this thing is concerned, because it's a brownfield. There is no significant fixed cost, or any fixed cost which is being incurred. It's essentially variable cost as and when you open the bed. And my belief is that it's only 100 beds in that location, which is a hospital which is operating at 90% plus occupancy at present. So it's untapped demand. As far as Dwarka is concerned, again, I think it's not really going to be dilutive, because it's a very sort of 300 beds on top of this thing. But I think the kind of response we've got, the ramp up and the break even and everything else should be very, very quick over there. So I'm not seeing any real dilution, okay, on an overall basis.
So broadly, the current level of margins can be maintained.
Absolutely. But again, like I said, please focus on EBITDA per bed rather than EBITDA margins. I would rather do a $10,000 surgery with a 20% margin than a $5,000 surgery with a 50% margin.
Okay, got it. My second question is on Nanavati Hospital. So you mentioned this facility is currently operating at mid-teen margins. So how long it can take further to reach near to the corporate average, or how should we look at margins for this particular unit?
Well, Mumbai by and large has a higher sort of doctor payout, Okay, so you typically have lower margins, but yeah, there is room to increase the margins over there. Do keep in mind, if one was to sort of increase the margins from by 5% to 6% also from here, it means on a 400 odd crore top line, 450 crore top line, you're talking about 22 crores, on a base of 1600 odd crores. So it doesn't really move the needle from that standpoint. But I think the big sort of swing will come over there when the new capacity comes in, which is, the construction is on.
Abhay, I think I just lost you in between.
Sorry. So I said that even if you look at a 5% increase in EBITDA margins per se, on about a 450 crore top line, it's about a 22 crore EBITDA increase.
Yes.
On an overall company base of, let's say, roughly 1600 crores.
Okay, got it.
So it's not really, but the big this thing will come over there when the new 500 odd beds come, which the construction is on, because these will really be and it will, what it also does is, it will flatten out your higher doctor cost as well as the personnel cost.
Okay, so operating costs will be spread over a larger bed network, and that will obviously...
So actually, there is, and as far as Nanavati is concerned, there is a legacy personnel cost, okay, which is the workers' cost. Okay, that's the only single line item which is off whack. I mean, it's 30-31% compared to 22-23% for the rest of the group. Okay. And that either through expansion of capacity or through VRS is the two ways of tackling it. We tackled it partially through VRS. We may be looking at another VRS going forward, but more importantly, I think when the new capacity comes in, it gets taken care of by itself.
Okay, and my last question is on seasonality on a hospital business. So 2Q, as you said, due to rainy season, we have higher incidence of infections, etc. So 3Q, should we assume it will be a lower quarter due to like major festivals falling in, and again, fourth quarter should be a better one? Or how does this seasonality vary across a different quarter?
So let me put it this way. Usually your Q1 and Q3 are the sort of weaker quarters, right?
Mm-hmm.
But rather than timing it like this, because sometimes Diwali is there, and so on and so forth, H2 is usually better than H1, historically for all hospital groups.
Okay, so very broadly, second half perform better than the first half.
Always. I think, if you see any hospital group, typically and historically, our hospitals or any other hospitals, H2 is much better than H1.
So you'll see a 48-52 type in EBITDA.
Yeah.
Revenue will be 49-51 type.
49-51.
I mean, historically, I'm just giving you based on, experience or whatever, but I'm not giving you a guidance.
Yeah.
Usually at 48-52, first half versus second half.
Okay, got it. And final clarification, CAPEX, you maintain whatever budget we have done or we have disclosed earlier, that remains on track, and this lower CAPEX in first half of this fiscal is just a matter of timing issue, and eventually, as in when payments, etc. start happening, it should be in the budgeted line.
Yeah, so I mean, if I was to look at things going to come up in the next 1 year, okay, there is obviously certainty because we know where we are in the fit outs, etc. over there. As far as, anything which is coming up, really is bunching up towards the end of 24, 25, and 26, I think there is strong visibility that we should be able to meet timelines over there.
Okay, well, that's very helpful. Thank you.
Thank you. The next question is from the line of Praveen Sahar from Edelweiss Wealth Management. Please go ahead.
Yeah, thank you for taking my question. One clarification related to the bed addition. Beyond Shalimar Bagh and Dwarka, you have a major bed addition plan for FY25. So is there any deferment in that 1170 bed odd?
Not really, no. Like I mentioned, the visibility is there and works have started. At the same time, I just want to sort of also layer it up that we all, like I mentioned, the reason I was going down to about 15% institutional share is because I had visibility of this coming out at that time. Let's say hypothetically speaking, some project gets delayed at the end, and let's say it's not adjacent to a place which is at zero institutional, you still have the lever, by the way. So having said that, just squarely answering your question, we are not right now, as far as our visibility is concerned, we're not foreseeing any delays.
Okay, great. And the second question is related to the ARPOG. For a sequential basis, if I look at your ARPOG is around 66K, even after improvement in the payer mix, like institution gone down to 28%, and the international patient mix also improved. There also sequential improvement we had seen. So what exactly on the QOQ basis related to that flat ARPOG?
Can you just repeat that question? Sorry.
So I think basically this is because of the fact that the medical mix of the patients have gone up during this quarter. I think Abhay mentioned this earlier also, that in this quarter two we have some dengue and viral fever patients, etc. So the internal medicine has jumped by 26%. You've seen that comment in the earning update also. So it's basically because of so if it was not to happen, generally you'll find that the ARPOB will drop in quarter two compared to quarter one because of the medical patient going up, right? Medical patient typically, the dengue patient will be 60% of the normal ARPOB that we have. Right, so it should have dropped by the fact that we have this institutional share going down and the interest going up, so it's been maintained at the same level.
Yeah, got it, sir. Got it. Thank you for answering my questions. All the best.
Yeah, but purely you can't look at it like, look, the occupancy went up, so there's a secular increase in occupancy also of your business as usual, right?
Yeah, I got the answer. Because of internal medicine increased the contribution, maybe that is the reason why the ARPOG is maintained on the same level.
Yeah.
Thank you, sir.
Thank you. The next question is from the line of Shaleen from UBS. Please go ahead.
Hi, Shaleen.
Yeah. Hi, Abhay. A great set of numbers. Congratulations on that. So, Abhay, more of an understanding thing. See, I understand your institutional patients are coming down, but is it right way to think that they generally take general ward, right? So you will be replacing them with a patient in general ward, right? So probably my improvement in ARPOB when I replace institutional patient will not be the same level of my average ARPOB.
That's not true. Okay, let's say you are working in Northern Railways, right? Who are these people effectively? These are public sector undertakings. They're Delhi Jal Board. They're various central government this thing, etc. It could be anybody from income tax to let's say from irrigation department, right?
Supreme Court, etc. All probably IAS officers also.
Yeah. All IAS officers, Rajya Sabha members, Lok Sabha members, former members, etc. All judges, all Supreme Court judges, High Court judges, and so on and so forth.
Understood.
Yeah. Now, each one of them, if you're a lower sort of tiered officer, you are let's say a class 3 employee or whatever, then your allocation or your entitlement, like in insurance, okay, maybe general ward. But if you're a judge or if you're an IS officer, whatever else it is, it'll be single room or deluxe room. Well, single room. Okay.
Right.
So what you're replacing it by is not that. The other thing you need to keep in mind is my 66,000 ARPOB, right, is a weighted average which includes the 36,000 of CGHS as well.
Yeah.
What actually replaces it is the higher ARPOB.
No, it replaces, but will it replace by the hospital average? And I think what you said is possible, yes.
Right. But the other point I want to make is that, yes, although we are talking about reduction in institutional business, right? I think the right way to, and the best way to think about it is increase in the non-institutional business.
Right.
Because if you can increase occupancy, right, that's what I sit with my teams on. I'm saying, look, rather than pushing, your best case scenario is where you can find ways of increasing occupancy, retaining this, as well as increasing your, finding ways to accommodate your preferred channels.
But you yourself said, right, that beyond 80%, it's like service compromise can happen. So too difficult to, I mean, I don't know.
Today, yes. Like I said, 2 years back, somebody asked me at 75%, I would have said, no, you compromise. The fact is, and I'll give you an example of Beach Candy Hospital in Bombay. I mean, your service is not compromised, it operates at 90+% occupancy. It's just that over a period of time, they found ways to do it. You become more efficient. If you look at Hinduja Hospital over there in Mumbai, I mean, they've got 27 ICU beds. They've got the lowest ALOS because they got it down to a T. And simply they got it down because they've been living with this situation of saturation where they can't expand it even by a square inch for so many years. I mean, everything is down to just in time and so on and so forth. But yeah, those are all incremental efficiencies, but I still want to sort of put that down.
But that's important, right? Because as a modeling perspective, when we model, we start doubting that whether the hospital can hit beyond 80%. But if you see there is a possibility and there are models and you can kind of build in, then it's very interesting thing and very important point for us to not have a ceiling.
I have hospitals right now operating in 90% plus.
Okay.
And without compromising anything. Because that's one place we put our foot down. As far as, what you don't want is, and immediately you see a sort of a pushback in the next couple of quarters, your doctors will have a problem, your patients have a problem, and so on and so forth. Our PSAT scores, all of that, okay, on a daily basis, which we look at, is been increasing and improving.
Right. So do you have a score like NPS score kind of thing as well here? Do you patient satisfaction score? Do you track something like that?
Oh, absolutely. Multiple listings, including, and we do it through, even SMS listings, etc., where it's voluntary for you to sort of respond to it. So although, you'll only have 4 or 5% people responding to it, okay, but those are very true sort of listings, right? Because it's not as if you're sitting in a hospital where the management or the nurse is coming up to you and says, sir, please sign this.
Mm-hmm. Okay.
And multiple listings, we have,
Understood. Abhay, you also mentioned about moving away from probably a traditional way of construction. Are you going with hollow structural tubes for the construction instead of RCC?
No, so look, we evaluate hollow tubes versus structural steel frames, okay, or let's say composite. So you do your basements, we still have to do in concrete. We are still finding ways of doing that mostly in steel as well. But the rest of it you do on steel frames, which is very, very You see, unlike, the cost of construction is maybe higher by 15 or 20%, but if you can save 20% of the time, okay, right. In our case, okay, you can get to market that much sooner, because for me, every day is the loss of profit, right?
True.
So unlike a residential real estate, where the cost of construction matters because the delay is to, let's say, the consumer's account. Here, it's actually I have a positive incentive for me to get it up and about sooner than later.
True. So ballpark, have you looked at the IRR? Basically, it's all about IRR at the end of the day, right? So it's positive, it's accretive. If you
So look, I mean, each day, I mean, when you have a cost of construction on a brownfield of, let's say, 130, 150 lakhs or whatever, and your EBITDA per bed, okay, is 60 odd lakhs. Okay, you may as well get that sooner. You have 50% ROC. I mean, the question is how soon do you get to that 70%, 60%, whatever that occupancy is. And largely these are brownfields, right?
But
and like I said, it's unsatiated demand at my doorstep. I have no fixed costs. I mean, there is absolutely no benefit on any Excel sheet for even a day's delay on this.
So, Shalin, also it is about the patient convenience, because, when you have the traditional, construction, you have more disturbance to the patients who are in the hospital, right? So there obviously be noise, etc. So I think by doing this structure, you are also able to reduce the interference into the online operations.
No, I very much agree.
Let's say you're doing it in Nanavati, right? So you already have a running hospital there. Right? If you have all this building out there, doing there, and you have a lot of construction activity going on there, this obviously disturbs people, right? And you can't do 24/7 construction in that case. So I think this allows us to, fabricate the stuff outside and bring it in, and so it's a faster construction and also lower disturbance on the site, especially where you are running the hospitals.
Fair enough. No, that's very, very interesting, I think, and that's a great move. That's That's about from my side. Thank you so much.
Thank you. The next question is from the line of Dheeresh Pathak from White Oak Capital. Please go ahead.
Yeah, thank you for taking my question. So can you give the capex outlay for the Dwarka project and as well as for the Shalimar Bagh?
So as far as Dwarka is concerned, we are not incurring the capex. Okay, will be about 130 odd crores. You can give the precise figure as far as the medical equipment is concerned. The capex is being entire capex, okay, is being incurred by the developer. We have a fixed rental that we are going to be paying him, which which is 20 odd crores. Yogesh, can you give the details on both Shalimar Bagh and?
Shalimar would be roughly a cost of 150 crores, including the equipments. And on the Dwarka one, that'll be around 170 crores because we are expecting the linet also there. Now this is 170 crores is in addition we've given some deposits to these guys, to start with as a when you sign the contract. So that's the kind of investment that we have. So 170 plus 150.
And what is the rental in the Dwarka? 20 crores.
24. What is it? Yogesh?
H1. The rental in Dwarka would be 22 crores a year.
22 crores. Okay. Sir, on the labs business, can you give like the share of revenue from B2B and B2C?
Yeah, so I would say it will be a 50-50 type of thing. So 50% will come via B2B. When I say B2B, this also includes franchisees, right? And balance will be B2C.
But franchisee in two terms it is B2C, right? But the HLM business would be typically
so
B2B.
HLM will be around 20% of the business will be HLM, right? Okay. And 25% will be coming via the franchisee. So another 5% through the this Flaboat side, etc. Balance will be all direct, including Kotos and home pickups and the wellness, etc.
Okay. So one last question for Nanavati. What would be the EBITDA per bed?
EBITDA, Yogesh? 50 odd lakhs?
We don't share the hospital level EBITDA per bed.
Okay, because the numbers you said is double digit EBITDA margin, and if I do the math,
Mid-teens.
450 crore revenue you said, right? And 15% margin.
Yeah, it's around 15% margin, yes. So I would say it's actually in quarter 2 it's around 16% margin, right? And you have the revenue from Maharashtra already in that distance, so you can compute it.
Okay. Yeah. So then also it will look lower, and primary reason, like sir explained, is it because of the legacy doctor cost, which is 10 percentage points. Personnel cost. Okay. There's a union there, is it?
Yeah. But I mean, it's a benign union. That's not the issue. Is not that. The issue is that look, when you do a VRS, right? Typically, you pay, let's say, 6 months of salary for every year of service left, or 9 months of salary for every year of service left. So we did the first VRS with 6 months of salary for every year of service left. Now this thing is 1 year of salary for every year of service left. So rather than paying that out, I'm saying, look, the new capacity comes in, this gets defrayed over a larger this thing in any case, the excess manpower.
Okay.
So we also have to do cost benefit.
Okay. So even outside of that also, the EBITDA per bed, I don't know, based on the numbers you're sharing, even adjusted for that would look lower. So is there something else also in Nanavati, like is it lower occupancy, is it lower ARPOB apart from that?
Higher number of general ward beds at present.
Okay.
The configuration has fewer single rooms, fewer double rooms, attached bathrooms, etc. because these are older sort of buildings.
Understood.
So the big this thing over there is for single rooms.
Understood. Thank you for taking it.
If you're from Bombay, you'll know that you don't get a single room in these hospitals, right? I mean, you typically get an admission in lower category, then move up.
Okay. Great, sir. Thank you for taking my question.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. So just firstly on the international patients, will like historically, if at all, does the patient from Afghanistan have better realization when compared to what we are having from the current international patients? Or will that be just driving the volume if at all the Afghanistan patient starts coming into India?
Sorry? No, Afghanistan won't have any better, ARR, etc. So it'll be all the same. It'll be in the same range.
Okay. So it will drive the volume basically, not the realization.
Yeah.
Secondly, on the
nevertheless, you know that international patient, the ARR is generally double of the domestic, right? Because we get more acute patients there, and that obviously helps us, and it's more complex work that we get on the international side, and so obviously that helps us in terms of the ARPOBs and the EBITDA per bed, etc.
So your average bill is twice. It's not about the pricing; it's the average bill is twice.
But the resource as well as the service aspect also will be typically much superior compared to even on the cash.
In spite of that, I mean, if today I have a patient for a fracture and I have a patient for a liver transplant, right?
Right.
Okay, I make a lot more absolute margin. Okay, as well as the overall billing on a liver transplant. Of course, the resources are higher, but my margins are much higher. So when a person comes, okay, nobody's going to have a fracture and come from Afghanistan to get it sort of sorted over here, but you come for a life-saving, a liver transplant or a life-saving procedure or whatever, where the average billing is much higher.
So approximately what would be the... Sure. Just to understand approximately what would be the margins from the international patients flow compared to the company level margin? Just a broad picture.
No. You see, again, you're talking margins in percentage, which is the wrong sort of cadence to look at. Well, like I said, you'd rather do a 20% margin, okay, on a $10,000 surgery than do a 50% margin on a $2,000 surgery, right?
Right.
Okay, so what I'm telling you is the average billing is twice.
Got you, sir. And secondly, on the case mix side, the cardiac side seems to be improving nicely over past couple of quarters. And oncology remaining pretty stable. So while the payer mix change can definitely drive the ARPOB, but from a case mix perspective, typically cardiac is relatively lower compared to oncology. So will that have certain impact on the overall ARPOB?
No, and you've seen it like you said yourself, right? You've seen it increase, yet you've seen overall increase in ARPOB, correct?
Okay. And just lastly, just to understand the mix of, so while this quarter had a viral load, maybe on account of dengue, so the typical mix of surgery and the medical business for the quarter or for the first half, and how probably that can change in the coming when there is no viral infection per se. So any broad color on that?
So Prashant, this was down. The medical mix was up by 2%. This time, so let's say this was generally 43-57. This time it was 45-55. 45 for medical. So in quarter one it was 43-57. So I think as we get into quarter three, I think this will normalize to the old levels.
So effectively resulting into, let's say, a ballpark, what kind of increase in ARPOB, or is it like in the meaningful range of 1,000, 2,000 rupees or much more than that because of change in this proportion?
No, I can't obviously review the figures, what would be the change, but I think you can see that, a 2% change in the mix of the PSU patient and an increase in the international of the level which has come in the quarter two compared to quarter one. If that increase was to happen, there's obviously, as I said, the ARPOB is 1.5 times for the international, and for the PSU it is double. So if you compute that, you'll get to a number.
Okay, sir. That helps. Thanks a lot.
Thank you. The next question is from the line of Bharat Seth from Quest Investment Advisors Private Limited. Please go ahead.
Hello.
Hi.
Thanks for the opportunity. Sir, you said typically in Mumbai, doctor payout is higher than the rest part of the world, Is that correct understanding? And if that is there, what exactly are we doing to retain this kind of a talent, for our hospital? And in future, then would you like to go for a Mumbai?
Sorry. So in Mumbai, I compete with other hospitals in Mumbai, right? So the doctor payout, which is higher for me, also applies to all other hospitals.
Sorry, I don't get you, sir.
So my Mumbai hospital does not compete for doctors against hospitals in other parts of the country.
Correct.
They compete with hospitals in Mumbai.
Fair.
Okay, so it's a secular trend that the doctor payout in all hospitals across the Mumbai are similar, which is higher than compared to the rest of the country.
Fair, sir. But then ARPOB in Mumbai is much higher than the rest of the country, vis-a-vis the way, because the payout is higher.
Not necessarily. The doctor payout has nothing to do with the ARPOB.
Fair.
Your doctor payout is a cost line. Your ARPOB is a revenue line.
Okay. And sir, can you share some kind of, broader statistics, say, apart from all these metro city, how these international tourists, which city attracts more international and which is less?
Number one place in India is Delhi NCR. 40% of all medical tourists come to Delhi NCR.
Okay.
The rest is distributed. Mumbai share is the least.
Fair. Second, sir, now since we are currently next 2 years we will be expanding brownfield. But once we go for a brownfield opportunity is over, and if we go for a greenfield, then it will be taking a little hit on the margin. Is that understanding correct?
No. Well, when you do greenfields, which are sizable in nature, okay, compared to the rest of your portfolio, okay, it will have, sort of temporary this thing in towards your margins. Okay, it does not mean that you give up that opportunity, when you have that opportunity. So if I get opportunity to do, let's say, 3 greenfields right in the middle of Mumbai, not that I'll get the land for it, but if I was to, I'd do it, right? But having said that, we have a large base of 1,600 crores of EBITDA, about 6,000 crores of top line. So how much will it impact it by is the question.
Okay. Fair. So last question, sir. We have several levers for expanding the margin. So when we are talking currently, we have around annualized 65,000 rupees to 67,000 per bed EBITDA. So with all this lever, what is our aspiration? And of course, occupancy also increasing.
Like I said, I cannot give you a forward-looking guidance on EBITDA on this thing. Our EBITDA is 64 lakhs, not 1,000.
Sorry, 64 lakhs, sorry.
Yeah, per bed. As far as the levers are concerned, all of them should augur better and improve this going forward. Some sort of calculations you can do. Like I said, I'm reducing institutional bed share by 13%. In absolute terms, so that means that 13% should be able to generate at least 50% more revenue. 85% of that will flow to EBITDA, so that has some impact on your EBITDA numbers, your international patient increasing, your insurance patient increasing, etc., etc. So I think overall we are in a good space. Exactly where it will lead you to which quarter is something for you to estimate. But like I said, I think, as a sector, as a company, we are in a good space. We are generating a significant amount of free cash flows, and we have very good land banks right in the middle of the metros. From 85% capacity, we moved to 93% capacity post-expansion. We already have these lands where work has started, most importantly. And there's an opportunity set in the rest of the country. And I've always gone out to say that, look, any location which is viable, where at least 2 of my competitors have proven viability, we'd be more than happy to sort of enter those places. And of course, M&A is another big lever for us, and that will throw out further geographies and opportunities for us. We certainly have the balance sheet and the cash flows to support those expansions.
Okay. So what are the, while criteria for M&A, do we still, would like to have evaluating any 33% kind of ROC would like to generate?
Of course, in the long run, of course. I mean, it may not be immediately available, that sort of ROC, but yes, over a period of time, through those assets, through further expansions over there, brownfield, etc., you can unlock value. Because do keep in mind, brownfield expansions allow you a significantly higher ROC than your present set of operations. Because the EBITDA per bed is much higher in a brownfield. And there is no stress on your, even your short-term sort of EBITDA margins.
Okay. Thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Harith Ahmed from Spark Capital. Please go ahead.
Hi. Thanks for the opportunity. So, looking at our disclosed bed addition plans, we have roughly 1,500 new beds getting commissioned in FY25, and I believe a higher number probably in FY26. So how should we think of the payer mix specifically at these new beds? Will we stick to our targeted 15% share from institutional patients, or will we prioritize occupancies and probably accommodate a higher share at these new beds?
So, look, 15% is a derived number, right? Essentially, what we believe is that the reduction in institutional business will stop when this new sort of capacity comes in. It's beneficial that majority of this capacity, or almost all of this capacity in 25-26 is all brownfields. So it will not disturb the payer mix at that time, but at the same time, any further acceleration will stop towards non-institutional. Yeah, so I mean, I don't, and then again, coupled with the fact that, look, you've got a lot more operating levers for almost all of this capacity because it's brownfield, it will not disturb your payer mix or your margins at that stage.
Okay, got it, sir. And in terms of M&A priorities, are we open to assets outside metros and tier 1 cities, which is our current?
No, absolutely.
And also assets outside the north region of the country, which is again our core market today?
Look, we have capabilities of executing anywhere in the country. On similar sort of models that we understand. Okay, my only criteria has been that in a new geography, I don't want to do a greenfield, and B, I don't want to go to uncharted territory where, I only want to go to places where at least one or two of my competitors at least have proven viability. We will do it better like we do in each and every micro market that we compete in without exception. And you have witnessed to that over quarters, right?
Got it. Thanks for taking my question.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to the management for closing comments.
So thank you so much for your time, for logging onto the call, and we look forward to connecting with you in the next quarter with good news again. Thank you.
Thank you. On behalf of Max Healthcare, that concludes this conference. Thank you for joining us, and you may now disconnect your line.